Hello and welcome to Stockwatch Live. We have a raft of results due in from the insurance sector this week. Full year results are due from Direct Line Insurance on Tuesday, Legal & General on Wednesday, and Admiral and Aviva on Thursday. Now, of course, say insurers, and the first thought is likely to be who you have your home or car insurance with. But the likes of Legal & General and Aviva have got more to worry about at the moment than claims over damage from potholes and spilt red wine. The UK's life insurers, and in particular Aviva and L&G, which rank second and third largest when it comes to the UK's bulk annuity market, are facing a potential battle with newcomers. It's all because of the arrival of so-called pension super funds, which are designed to give companies more choice over what they do with their old defined benefit pension schemes. That's all well and good, but these super funds are threatening to undercut the likes of Aviva and L&G by as much as 50% in one of their core business areas. Bulk annuities is an important market for the likes of Aviva and L&G. It's one of the few growth areas across the UK life insurance sector, and it's an area that's expected to grow significantly in the future. It's also a very important source of new business. But that's all being threatened by aggressive competition from this new breed of consolidators who look poised to go for the exact same schemes insurers are targeting. As they can afford to undercut them significantly, that could prove disastrous for traditional life insurers. And for Aviva, it's the sort of problem it could well do without, having had a torrid time of it in 2018. With a sinking share price, no one at the helm, and an ongoing investigation by regulators, whoever fills the vacant role of chief executive will have their work cut out, not least persuading shareholders that the business can grow. The share price says it all. Having lost more than a quarter of their value over the past 3 years, far worse than rivals L&G and Prudential, the shares slumped a further 20% after Mark Wilson, the insurer's chief executive, was shown the door in October. Blame Brexit and trade war worries for playing a part too, but whoever fills Mr. Wilson's shoes will need a thick skin and a sound strategy to win round investors. Broker Jefferies International rates the shares a buy, but has cut its price target from 604 pence to 500 pence. Just Eat is one company that is about to find out exactly how it feels when a rival strays onto your turf and undercuts you. The UK's largest food marketplace that connects diners with restaurants is set to face tough competition after Uber Eats has waded into its territory. Previously, Uber Eats, much like Deliveroo, mainly used its own couriers to make deliveries to customers while charging restaurants a higher commission. Investors will undoubtedly want to know how Just Eat intends to counter this competition when it posts full-year results on Wednesday. And no doubt it will also want more on its response to calls to merge with a well-run industry peer, which 2.2% shareholder Catrock Capital suggested in an open letter to the company. UBS rates Just Eat's shares a buy, but has cut its price target to 870 pence from 930 pence. Liberum Capital is also a buyer, but is much more bullish and has a £13.20 target on the shares. Now, whether you see it as a smart gimmick or you're a bona fide fan of Greggs' vegan-friendly sausage roll, there's no denying it's pulled in the punters. Having already started the year with an upbeat revision of expectations for its forthcoming full-year results, it's revised its forecast upwards yet again. In January, it said a strong end to 2018 meant pre-tax profits for the year would now be slightly ahead of its previous guidance of £86 million to at least £88 million. It's since been back to say profits are going to be even better after an exceptionally strong start to the year, driven by the launch of that vegan-friendly sausage roll. That obviously pulled in intrigued customers who clearly went on to sample the vegan version or else plump for one of its meat sausage rolls instead, as sales of these savouries soared, the company said. Investors will have to wait until Thursday to find out if the novelty has worn off or Greggs is still on a roll. Having downgraded its recommendation from buy to neutral just days before the revised profit forecast update and set a new raised price target of £16, UBS was back for more a few days later with a new price target of £17.25 on the shares. HSBC remains a buyer and has set a price target of £16. Well, that's all for this week. For coverage of the companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.